we are kicking things off with a massive story about global trade and the electric revolution. China's EV manufacturers are absolutely dominating the scene, exporting 350,000 electric vehicles in March alone, marking a massive 30% jump from February and a staggering 140% increase from last year. We dive into how this surge is reshaping the entire automotive landscape and what it means for the world economy right now.
Tired of dropping your phone or struggling to hold it with one hand? The PopSocket's Pop Grip gives you a secure grip, works as a phone stand, and even lets you swap the top for a fresh new look. Simple, useful, and perfect for everyday phone use. Click the link in the comments to grab yours on Amazon.
Next up, we look at the heavyweight battle in the EV market. Tesla has managed to reclaim its position as the leading global EV manufacturer after trailing BYD, delivering 358,023 EVs in the first quarter. But we investigate if that victory is sustainable when facing rising competition and shifting investor expectations. Now let's shift focus to premium automakers. BMW is making a massive strategic pivot, moving beyond the iX as the brand enters a new EV era called Neue Klasse, with the new iX3 set to launch in 2026, signaling a major shift in their American strategy. And finally, we explore where the next growth is coming from. Hyundai is making a bold bet, focusing on China with the Alexio EV and plans for its Ioniq EV concept, navigating the slowdown in the US and Europe. Stay with us, because this is the future of mobility. China's electric vehicle manufacturers are capitalizing on global trade disruptions caused by the war in Iran, emerging as significant winners in the evolving automotive landscape. Data from the Chinese Passenger Car Association indicates a surge in exports, with Chinese manufacturers shipping 350,000 electric vehicles in March alone, marking a 30% increase from February and a 140% jump compared to March of the previous year. Across the first quarter, China's total EV exports grew by 77.5% year-over-year, according to Customs Administration figures. While domestic demand in China is softening, with domestic EV sales declining by 21% in the first 3 months of 2026 due to high penetration rates, Chinese automakers are strategically pivoting towards overseas markets. This shift is bolstered by soaring global fuel prices, which are encouraging consumers to switch to electric vehicles. Diesel costs in some Southeast Asian nations have surged by over 100% since the conflict began in late February, highlighting the geopolitical vulnerability associated with reliance on Middle Eastern oil. However, the EV sector faces supply chain headwinds. Rising costs for crucial manufacturing inputs, such as sulfur for copper purification and the extraction of nickel, cobalt, and lithium for batteries, are pressuring profit margins. Disruptions to seaborne routes, particularly through the Straits of Hormuz, have driven the price of sulfur to a 4-year high of $940 per ton at the end of March. This situation presents a double-edged sword. While increased EV interest is noted, supply chain snarls are complicating production. Legacy auto markets and advanced economies remain the most lucrative destinations for Chinese EVs, with Europe being the largest importing region by dollar value. In response to concerns over market saturation and reliance on Chinese technology, many nations are implementing policies to encourage local manufacturing. Examples include Malaysia, which permitted BYD to establish a local factory contingent on exporting 80% of its production, and the European Union, which has introduced guidelines allowing Chinese exporters to set minimum sale prices instead of imposing flat tariffs. Mexico is also responding, with tariffs on Chinese imports prompting companies like BYD and Geely to bid for local manufacturing sites to circumvent trade barriers. Tesla has reclaimed its position as the leading global electric vehicle manufacturer, a development that has boosted investor sentiment. Following several months of trailing BYD's total battery-only electric vehicle production, Tesla delivered 358,023 EVs in the first quarter of this year, surpassing BYD's 310,389 battery-powered vehicle sales. While this marks a significant win for existing shareholders, a deeper analysis reveals complexities that temper the bullish outlook. Tesla's reported figure fell short of analyst expectations of 365,645 vehicles, and it is crucial to note that BYD's total includes its growing hybrid vehicle sales, a category Tesla does not manufacture. Furthermore, Tesla continues to lose total market share both domestically and internationally, particularly in Europe, signaling a challenge to its pricing power amidst increasing competition. This pressure is reflected in the company's adjusted EBITDA margins, which have steadily declined from a 2022 peak of nearly 24% to under 16% in the last year. A key strategic divergence is the company's focus. Instead of aggressively developing more price-competitive, high-margin vehicles, CEO Elon Musk appears to be prioritizing the development of autonomous humanoid robots intended for household labor, projecting them to be commercially viable and cost-effective by the end of next year. However, given Musk's history of ambitious timelines, shareholders should remain cautious regarding the projected launch dates for these AI androids and the cybercab. While the electric vehicle business remains the core of Tesla's revenue, sustained success will require more than just positive quarterly EV reports. Investors must assess whether Tesla can effectively navigate intensifying competition from rivals like BYD and other EV manufacturers. The future hinges on whether Tesla can successfully pivot its strategy to maintain market share and restore profit margins in a rapidly evolving EV landscape. Neue Klasse. BMW is signaling a significant strategic pivot in its electric vehicle strategy in the United States, moving beyond its current electric lineup and ushering in the new class era. Recent sales data indicates a challenging period for the brand in the U.S. EV market, with battery electric vehicle (BEV) sales declining sharply. In 2025, BMW's BEV sales fell by 16.7% to 42,484 units, and the fourth quarter saw a more severe drop of 45.5% to just 7,557 units. Furthermore, overall electrified sales, combining BEVs and plug-in hybrids, dropped 50% year-over-year, with estimates suggesting BEV sales alone fell by nearly two-thirds. This trend suggests that American consumers are not entirely abandoning electrification, but are increasingly favoring plug-in hybrids as a transitional option. And this recalibration is most evident in BMW's decision regarding its flagship electric SUV. The iX. The company has confirmed that U.S. allocation for the iX will conclude after the 2026 model year, as the focus shifts to next-generation technology. This move is framed not as a retreat, but as a strategic delineation, separating the initial phase of their EV experimentation from a more advanced future. The iX, which saw an 18.2% volume decline in the U.S. between 2024 and 2025, will remain available in other global markets. And the future of BMW's electric portfolio centers on Neue Klasse, the brand's next major EV architecture. This new generation promises significant advancements, including a redesigned look, 800-volt Gen 6 eDrive hardware, enhanced charging speeds, and improved efficiency. The rollout begins with the new iX3, which is slated for market launch in both Germany and the United States in 2026. The iX3 is positioned with ambitious specifications, reportedly offering up to 500 miles of range on the WLTP cycle and charging speeds up to 400 kW, pending final U.S. EPA figures. Neue Klasse technology is planned for broader integration across the entire portfolio by the end of 2027, with the i3 sedan already revealed as the second key model in this transition. BMW's strategy clearly indicates a focused effort to develop a more advanced EV offering designed to meet evolving American buyer preferences. Hyundai Motor is aggressively repositioning its global strategy, focusing heavily on the Chinese market as a primary engine for future growth, following recent geopolitical shifts and softening demand in Western markets. Industry analysts suggest that the recent exit of Russia and the slowdown in electric vehicle (EV) adoption across the United States and Europe have created a strategic opening for Hyundai to accelerate its presence in Asia, particularly China. This strategic pivot is evidenced by several key moves by the automaker. Hyundai has specifically tailored its offerings for the Chinese consumer base. This is highlighted by the development of the Alexio EV, a model explicitly designed with Chinese customers in mind. Furthermore, Hyundai has established a significant physical footprint in the region, operating a dedicated plant in Beijing, signaling a deep commitment to local manufacturing and supply chains. Adding to the momentum, Hyundai is preparing for a significant product launch tailored for the Chinese market. The company has unveiled a concept car intended for its Ioniq EV brand, which is slated for introduction in China. These coordinated actions, from targeted product development to establishing local production capacity, underscore Hyundai's calculated bet on China to drive its next phase of global expansion, bypassing the headwinds currently affecting the European and North American EV sectors.